Welcome to the Deep Dive, where we cut through the market noise, we take financial filings, we take data, and we try to extract the insight you really need.
And today we have a fascinating one. It's a strategic document that it really reads like a declaration.
It does. We're looking at Peter Thiel Macro LLC's Q3 2025 13F filing, and our mission today is to unpack what one of Silicon Valley's most successful figures has just done.
It's been called a violent pivot, and that's not an exaggeration.
Exactly. So we're going to look at why he made such a dramatic move and what this extreme concentration tells us about the market and maybe the AI hype cycle.
And it's really crucial, right up front, to be clear about the entity here.
Yeah.
This is Thiel Macro LLC.
Right. This isn't his personal stuff or founder's fund.
No, not at all.
Yeah.
This is his liquid public market trading arm. And that distinction is everything, because what we're seeing is a fundamental rejection of his previous public market strategy.
So in short, he shed these high-flying, narrative-driven stocks.
The market darlings, yeah. And he consolidated all of that capital into what you could only call a hyper-concentrated fortress. A fortress built on just 3 stocks.
Okay, let's get into that. The great liquidation. I mean, the numbers here are just staggering.
They really are.
The fund saw a massive, around a 65% contraction in its reported assets?
That's right. It plummeted from about $212 million all the way down to just $74.4 million.
And this wasn't just the market going down. This was a surgical, intentional liquidation.
Absolutely. It resulted in an 80% portfolio turnover rate.
80%.
Yeah.
That just screams a total loss of faith in what you were doing before.
It's a huge conviction move.
Yeah.
And it was really defined by 2 major complete liquidations. First, the fund completely exited NVDA.
Selling every single share.
All 537,000 of them.
And you have to remember, this wasn't just some small position. NVIDIA was the anchor of the fund.
It was over 40% of the entire portfolio in the second quarter. To sell the AI bellwether, the absolute centerpiece of this market cycle.
Or right at its peak.
That sends a massive signal. And second, they got out of Vistra, VST, the energy generation firm.
So he's selling the AI hardware and the power needed to run it.
Exactly. He's stepping away from that kind of diversification and speculation for something much purer, a higher quality tech portfolio.
Let's stick with that NVIDIA exit for a second, because this is where it gets really interesting, I think.
Yeah.
He sold the definitive AI winner just as its valuation was screaming past $5 trillion. He's basically putting his money where his mouth is after all those warnings about an AI hype loop.
He is. And this isn't some outsider looking in. This is the ultimate industry insider.
Co-founder of PayPal, Palantir.
His VC peers are the ones funding the startups that are NVIDIA's main customers. So for him to exit, it suggests the belief that this VC-funded spending boom that's fueled NVIDIA's rise is either peaking or the risk-reward just isn't there anymore.
It's a classic top-of-the-cycle move.
It really is.
So he liquidates all that, and he's left with this pure tech book that you've described as a barbell. What does that structure actually look like?
It is extremely focused.
Yeah.
As of September 30th, 2025, the fund holds exactly 3 stocks.
Just 3. That's the entire portfolio.
That's it.
Wow. Okay, so tell us which 3 made the cut. How are they weighted?
All right, so number 1, and this might be a surprise, is Tesla, TSLA. It's still the largest single position at 38.8%.
Didn't he sell a lot of it?
A huge amount. The share count was slashed by 76.2%.
Wait, so it's still almost 40% of the fund, but he sold 3/4 of his stake. That sounds like deep conflict.
It's the definition of it. Huge conviction in the long-term idea, but extreme worry about the current price.
Okay, what's number 2?
Number 2 is Microsoft, MSFT. This is a brand new massive position at 34.1%.
I'm the third.
The third is Apple, AAPL, also a new large stake at 27.1%.
So the new thesis is crystal clear. 1/3 is a high-risk, you could say, non-consensus venture bet.
That's Tesla.
And 2/3 is locked down in these impenetrable platform monopolies, Microsoft and Apple. It's a defensive, quality-first stance.
And to really get it, I think we have to run these 3 through a classic quality-focused lens. What would Warren Buffett look for?
The moat, financials, management, valuation.
Exactly. Let's start with Tesla, the huge binary bet.
So why, after slashing his exposure, does Thiel still commit nearly 40% of this super concentrated fund to Tesla? What's the logic?
Well, a traditional value investor would look at Tesla and say there's no durable moat.
Right. Buffett wants that stable castle.
And Musk's philosophy is the exact opposite. He says the only moat is the pace of innovation, which is a high-risk treadmill. If you're just looking at the car business, the moat is basically non-existent.
But Thiel's not betting on the car business, is he? What's the real moat here that he's betting on?
It has to be the FSD data network effect. It's a pure AI moat.
FSD being full self-driving.
Right. Tesla has collected over 2.2 billion city miles of real-world driving data from its cars. That massive proprietary data set. It's the raw material for autonomy. Competitors just can't replicate that scale.
So this holding is really just a VC bet on an AI outcome, but placed in the public markets.
That's the only way it makes sense.
Okay, now let's look at it through that Buffett lens, the financial.
And this is where it really falls apart from a value perspective. It looks deeply concerned.
Buffett wants predictable earnings.
And Tesla give you volatility. The 2025 reports all showed declining net income. That's the opposite of what a quality investor wants.
Yeah.
And management. Elon Musk is the antithesis of disciplined capital allocation. He creates massive key man risk.
And the valuation, the numbers are just terrifying.
And they are. The PE ratio is sitting at an astronomical 270.
270.
If you run any standard discounted cash flow on the car business, the stock looks wildly overvalued. Fair value estimates are, often below $150. The only way you justify the price is if you value it as a physical AI or a robotaxi company.
So the conclusion is pretty clear. His Tesla holding is a bet on the binary outcome of FSD, while at the same time, he's acknowledging the massive valuation risk by cutting his share count so much.
Exactly. So now let's pivot to the other side of that barbell, the defensive flight to quality.
Microsoft and Apple. The fortresses. This is what traditional value investing is all about. Let's start with Microsoft.
Microsoft's traditional moat is justed. It's a fortress of high switching costs. You have over 90% enterprise penetration with Microsoft 365 and Windows. It's almost impossible for a corporation to rip that out.
But now there's a new moat, right? The AI infrastructure.
That's the new layer. Because of their exclusive OpenAI partnership, Azure is now the default cloud platform for large-scale AI. And Satya Nadella has been exceptional. He pivoted to the cloud, and now he's expertly integrating Copilot into all their existing products, just making those moats even wider.
And the financials are just a model of stability.
They are. The company generates this enormous, predictable free cash flow. We're talking well over $70 billion a year. So the synthesis for Thiel here is profound.
He's selling the volatile AI hardware.
NVIDIA.
And buying the stable, recurring, high-margin AI software.
Microsoft. It's a classic substitution for quality.
But let me challenge that for a second. Aren't Microsoft and Apple trading at historically high valuations? Is this really a defensive move, or is he just paying a huge premium for perceived safety?
And that is the core tension of the entire strategy. He's signaling that even if they aren't cheap in a conventional sense, they are the absolute safest place to put capital right now. He's prioritizing business dominance and predictability over valuation. He's saying, I'd rather pay up for a guaranteed fortress than risk capital on cheap speculation.
Let's turn to Apple then, his 27% stake.
Well, Apple is the ultimate consumer monopoly. The moat is that walled garden. The ecosystem is so powerful that the switching costs are just astronomical.
Once you're in with the App Store, iCloud, iMessage, it's basically impossible to leave.
Exactly. And financially, it might be the greatest cash flow generating business in history.
Astronomical ROE, huge cash generation.
And Tim Cook gets praise from Buffett himself for his capital allocation, diversifying into high-margin services, that massive share buyback program. Again, Thiel is willing to pay a premium for that kind of dominance and predictability. It is the ultimate defensive core holding.
So let's bring this all together. What's the final thesis here?
He's built a perfect barbell. You have one company, Tesla, that represents high-risk, venture-style optionality. It fails every traditional value metric. And that's anchored by two companies, Microsoft and Apple, that literally define what a Buffett-style quality fortress is.
So what does this actually mean for you, the investor listening to this? It seems like Thiel, a master of growth and speculation, is basically declaring that the speculative, hype-driven phase of AI is over.
I think so. The strategy is to move capital out of the assets fueled by hype and into the hands of the platform owners, the companies that already have the infrastructure, the customers, and the cash flow to monetize this technology for the long haul.
It's a really powerful risk-off signal, but it's packaged inside a high-conviction tech portfolio.
It is. And when an influential founder-focused VC like Thiel resorts to such a defensive public market structure, it signals a deep skepticism about the quality and valuations in the broader market.
That's a great thought to leave everyone with. What does it signal when even a venture capitalist is hiding out in just two behemoths and one calculated moonshot? Before we wrap up, just a quick reminder for you.
All the analysis we've discussed is based on publicly available sources. It is for educational purposes only and does not constitute investment advice. Please, always conduct your own due diligence before making any investment decisions.
And if you want to track total market temperature yourself, we encourage you to search and download the Buffett Indicator iOS app from the Apple App Store. It's a great tool for daily reminders on market valuation. Thank you for joining us for this deep dive into Peter Thiel's decisive macro pivot.
And if you found this interesting and want to access more advanced content, welcome to join our Deep Value Club membership.
Or you can subscribe to our channel on Apple and Spotify podcasts. Deep Value Investing. We'll catch you next time.